In this video, I'm going to talk about debits, credits, and T accounts. Debits and credits are how we increase or decrease accounts. Whether an account increases or decreases with a debit or credit depends on the type of account that it is. Accounts that you debit to increase, you will credit to decrease. And these accounts are expenses, assets, and dividends. Accounts that you credit to increase, you will debit to decrease. These accounts are unearned revenue, revenues, liabilities, and shareholders' equity. The normal balance of an account is the side the account increases on. If you remember the normal balance of an account, you'll know how to increase it and decrease it. Every account has a normal balance. To help remember the normal balance of the different accounts, I think of debt and curls. Debt accounts increase with a debit. And these are expenses, assets, and dividends. So these accounts all have a normal balance of a debit. When you're increasing the accounts, you would debit. When you're decreasing the accounts, you would credit. Curls accounts increase with a credit. These are unearned revenues, revenue, liabilities, and shareholders' equity. So these accounts have a normal balance of a credit. So when you increase these accounts, you credit. When you're decreasing these accounts, you would debit. Okay, so I'm going to use this T account to record these transactions listed on the side. And it's called a T account because it's shaped like a T, and it's for the cash account. So number 1 says record the transactions for April 26th. A says the ending balance as of March 31st, 2016 was $100,000. This isn't really a transaction. It's just telling you what the ending balance was as of March 31st. The March 31st ending balance will be the April 1st beginning balance. And since cash is an asset and it has a normal balance of a debit, you would expect to see the beginning balance to be on the debit side. So we're going to start with the beginning balance of $100,000. B says April 3rd, a customer pays $5,000 for services provided. The customer's paying for services. That means the company's receiving cash. The cash account is increasing, so you would debit the account for the $5,000. C, April 7th, the company paid $500 for supplies. The company is paying for supplies. That means that cash is going to decrease. Cash is going outside the organization. You decrease the account, it's a credit. So you credit for $500. D, April 11th, the company receives $1,500 from customers previously billed. So the company is receiving $1,500 from their customers. That means they're receiving cash. Increase the cash account, it's a debit. E, on April 17th, the company paid $7,000 in wages to employees. The company is making a payment to their employees. It's going to decrease the cash account, so it would be a credit. $7,000. F, April 23rd, the company paid $10,000 in rent and utilities. Again, the company's making a payment, so it's going to decrease the cash account, so they credit the account for $10,000. G, on April 29th, customers paid $20,000 for services purchased on account. So the customer's making a payment for services, so the company's receiving cash. It's going to increase the cash account, so it's a debit of $20,000. So number 2 says determine the ending balance as of April 30th. So we have the beginning balance, then we have all the transactions that occurred during the month, all the debits and credits. To determine the ending balance, first you add down everything in the debit column and you add down everything in the credit column. And the total of the debits is $126,500. The total of the credits is $17,500. To determine the ending balance in the account, you take the difference between these subtotals So the ending balance in the account as of April 30th, 2016 would be $109,000. Thank you for watching our video, and please visit helpmelearnthis.com for more videos, worksheets, and study guides.